Welcome to the Advisory Group's Managing Your Wealth in 2026 workshop. Let's first start with some introductions. My name is Manny Will, and I am a Senior Advisor here at the Advisory Group. Also speaking is Brent, the President of the Advisory Group, and Chris Lee, the Vice President of the Advisory Group. All three of us are certified financial planner practitioners and wealth advisors at our Diamond Bar, California office. At our firm, we partner with clients and believe that an educated client is our best client. So while we will always try our best to help you when it comes to your finances, we believe that knowledge is power. And one of our missions is to share with clients any knowledge that can better help them make an informed decision. As a reminder, it's always important to review that there are 5 key areas of financial planning. They are preservation planning, retirement planning, tax planning, estate planning, and investment planning. Now, as a comprehensive financial services firm, we try to always consider the impact of any recommendation we make on not just one, but all these areas for our clients. Today's presentation will be focused on investment planning and equity markets, and we will also share with you some proactive tax planning strategies. Now, to get us started on the core of our workshop, allow me to bring up our first speaker, Chris Lee. Chris?
Thank you, Manny. The U.S. equity performance in 2025 was very volatile, but also quite resilient, as it overcame early year disruptions like tariff concerns and geopolitical troubles. By year end, once again, equity markets generated record highs despite numerous sources of volatility. For the full year of 2025, investors who stayed the course were likely rewarded with solid positive returns. 2025 was the third straight year of double-digit returns for the S&P 500. So what buoyed equities and defended them against this volatility? The continued bull run was largely driven by optimistic investor sentiment around AI boom, robust corporate earnings, and interest rate cuts. The AI boom fueled technology sectors dominated by the Magnificent Seven, which, as you may know, includes Alphabet, Amazon, Apple, Meta, Microsoft, Nvidia, and Tesla. In addition to the AI boom, the strong corporate earnings and the Fed's 3 rate cuts also helped fuel the market rally in 2025. Although the markets finished higher than where they started in the beginning of the year, they clearly did not move in a straight line. The most obvious fluctuations investors experienced during the year occurred in April, when we saw a heavy market correction due to concerns about proposed tariff changes and their potential impact on inflation and the economy. As this annual chart reflects, those who stayed the course in 2025 were rewarded. The S&P 500 finished the year with about a 16% gain, and the Dow Jones Industrial Average finished the year up around 13%. Let's review some highlights from 2025. As mentioned, 2025 was a good year for investors. Inflation continued to move closer to the Fed's goal of 2%, particularly in the last half of the year when we saw 3 rate cuts in a row. The economy remained resilient and strong. While we remain optimistic, there is still reason for concern as volatility remains. Overall, 2025 was a good year for investors, and 2026 has already started on a positive note. When it comes to investments, interest rates matter, And in 2025, investors saw the last three Fed meetings produce interest rate reductions. After starting the year with a range of 4.25% to 4.5%, the Fed ended the year with a rate range of 3.5% to 3.75%. At the December meeting, the Fed indicated that interest rate cuts could continue at some point in 2026, but at a slower rate. The Fed has moved closer to fulfilling its commitment to achieving a 2% inflation rate. But rates are not there yet. Therefore, interest rates and their direction in 2026 still need to be watched. We will discuss more on this in a few minutes. The Consumer Price Index is a key inflation gauge. Despite initial fears of a rapid rise in inflation due to tariffs, by the end of 2025, the United States ended the year lower than the 3% inflation rate that opened the year. As you may know, bonds and interest rates move in the opposite directions. When interest rates rise, existing bond prices tend to fall. And conversely, when interest rates decline, existing bond prices tend to rise. Should the Fed pursue additional rate cuts, existing bonds could appreciate in value. Conversely, expectations of slower easing or persistent inflation pressures could push yields higher. Bonds can be an integral part of a well-diversified portfolio and usually offer stability during times of market decline. However, please remember, while diversification in your portfolio can help you pursue your goals, it does not ensure a profit or guarantee against loss. Long-term rates ended 2025 slightly higher than they started, while short-term rates dropped. While it can be enticing to look for great safety, remember that sometimes safety comes at a cost, and currently many major banks are still only offering very low interest rates for savers. According to Barron's, the average bank money market rate as of December 29, 2025 was 0.52%, and on average, a 12-month CD was at a rate of 1.9%. More recent data shows that not much has changed. For anyone who is interested in exploring sources of better interest rates, please contact our office. For the next section on the investor outlook, please allow me to bring up Mr. Brent Beverly. Brent?
Well, thank you, Chris. So let's take a look at what we might expect this coming year. While we can celebrate the strong returns of 2025 and remain optimistic, there are several key issues we continue to monitor very closely. Interest rates and inflation remain critical factors influencing the direction of the economy and equity markets. Now, additionally, a new Federal Reserve chair is expected to be appointed in May, and any changes in the Fed's approach to monetary policy will need to be closely watched. 2026 brings midterm political elections in November, in case you hadn't noticed, which have historically introduced periods of uncertainty as to the potential for shifts in congressional control emerges. Global economic conditions will also remain important considerations. U.S. equity markets tend to react pretty negatively to geopolitical and international concerns. And right now, in case you hadn't noticed, there are several negatively major geopolitical uncertainties out there to be watching for. So as we move through 2026, we will continue to monitor these developments and their potential impact on markets and your investments. As your financial professionals, we're committed to keeping you informed of developments that may affect your financial planning and to help you navigate an evolving economic landscape. Now, we already showed how the Fed changed interest rates in 2025. Looking ahead to 2026, the Federal Reserve did indicate that we should see some more rate cuts, albeit probably at a slower rate than last year. As a reminder, the Federal Reserve was created in 1913 as a response to the banking panic of that time. They didn't call them depressions or anything, they called them panics. And their central purpose is to uphold what is referred to as a dual mandate. Their dual mandate is to maximize employment and stabilize prices, which essentially means keep inflation in check. Now, they're scheduled to meet 8 times this year. As a reminder, the results of the Fed's meetings and discussions always present the possibility of an immediate or temporary volatility in the equity market movements. And if that happens, you should try not to react emotionally. It's a regular thing. Now, at this January meeting just last month, the Fed decided to keep interest rates the same, nor did they indicate any new direction or change was imminent. That said, there are indications politically that there could be additional reductions in the Fed rate later this year. We'll be watching. We'll see where the other 7 meetings go and see how the rates change. Now, equities, stocks, primarily respond to corporate earnings. And in 2025, most corporate earnings reports were healthy. Wall Street analysts anticipate continued strong corporate earnings for 2026. Now, according to the data gathered by the analytics from LSEG, on average, analysts are expecting companies in the S&P 500 to boost their earnings by as much as 15.5%. However, that said, nobody can predict the future. The crystal balls still don't work. Now, one of our goals as your financial professional is to keep monitoring these results so we can advise you as our clients moving forward. Now, we noted before that markets do not move in a straight line, and the last 3 years have done a good job of rewarding long-term investors. 2026 started on a very healthy note. We continue to follow the understanding that investing in equities is a long-term commitment, and we're still recommending equities as that long-term investment. Just because returns have done well, though, this is not the time to become complacent or make risky decisions. Now, we believe that volatility could still be prevalent and that investors should be cautious when making financial decisions. Again, we like a long-term strategy that should continue to be the benchmark for smart long-term investors, but volatility along the way is something we expect. A question on many investors' minds is whether we could experience another market correction similar to the one we saw last April, in April of 2025. Now, from a historical perspective, it's reasonable to expect that markets may experience a correction of 10% or more at some point during 2026. However, according to market analyst estimates, most major institutions continue to believe that equity markets will be higher by the end of the year. Now, check out this chart on the right. Each of these large analytical sources are expecting the S&P 500 to be higher at the end of 2026 than it was at the end of 2025. Some more, some less, but overall, expecting it to be higher. While market corrections can feel unsettling, they're normal, and in fact, a healthy part of long-term investing. Corrections help relieve excess speculation. They allow market valuations to reset after a period of strong gains. And as many analysts point out, they're not necessarily something to fear. In addition, many strategists continue to forecast solid earnings growth for 2026. Now, against that backdrop, markets may continue to move higher over time, even if there are periods of short-term volatility along the way. Now, our goal in sharing this perspective is to help you set your expectations. If markets decline and you have concerns, we encourage you to contact us before making any changes. We're here to help you. We're here to help you navigate any market turbulence with confidence. Let's do a quick summary of what we've just discussed. What should investors be looking for in 2026? The bull market is likely to continue into 2026, but it's important to remain mindful of the broader economic landscape. Inflation has not yet returned to the Federal Reserve's long-term target of 2%, so it's still a factor. While additional rate cuts may occur, they could happen at a slower pace than we've seen, raising the possibility of periods of interest rate stability, or what some people refer to as stagnation. The economy continues to show resilience, with key factors such as corporate earnings and employment remaining strong. That said, market volatility is still very much present, or we like to say prevalent. Maintaining long-term discipline and long-term perspective remains an essential part of going through these periods of uncertainty. A well-defined investment strategy is a critical component of your comprehensive financial plan. And we work closely with our clients to develop customized strategies that reflect your unique goals, your circumstances, and taking into account factors such as your time horizon, your tax considerations, your liquidity needs, risk tolerance, and overall objectives. There's a lot there. To continue, let me bring up Manny Chin-Che. Manny?
Thank you, Brent. One of our primary objectives is to help our clients make more informed financial decisions, which could lead to better outcomes. So let's take a few minutes to go over some key 2026 items to look out for. And we feel it's important to remember that proactive tax planning should always be a key focus when reviewing your financial decision. We believe that a proactive approach to looking at your tax situation can lead to better results than a reactive approach. Tax laws seem to always be changing. As you know, last year ushered in the One Big Beautiful Bill Act, and some of the changes were set to begin this year. Now, one of our goals is to point out as many tax-saving opportunities and strategies as possible for our clients. So let's briefly review some broad tax information and some potential tax reduction ideas based on the current laws. Now, please remember that not all ideas may be appropriate for your personal situation. This is for informational purposes only, and we always recommend you always try to address any tax strategy with a tax knowledgeable professional. So let's look at some helpful proactive tax planning strategies. The first step is to look at where current tax rates are. As we look at actions regarding taxes, we believe that first it's helpful to see how our income taxes are structured. The IRS has released the 2026 tax brackets. Now, there are still 7 federal income tax brackets, which have been slightly adjusted from 2025. And we'd like to note that the 2 lower brackets, the 10% and 12% green brackets there on your screen, are much lower than the higher brackets. For many taxpayers, we look to maximize the use of these brackets. At the other end, the red brackets in the 30% range are pretty painful, even though historically they are still relatively low. Then we have yellow brackets in the middle of 22 and 24%. Now, we believe it's important to remember that you pay tax on the higher incomes only on the amount over the prior level. You may hear us use terms such as filling up the lower tax bracket. So even if you go over that change point by a little bit, not the end of the world, you're only paying the higher tax rate on that overage amount. Long-term capital gains are still currently scheduled at a favorable rate for 2026. So if you're in those 10% and 12% tax brackets, your long-term capital gains, which is gains on assets you have held for over a year, 0. Pretty nice, isn't it? In those middle tax brackets that we just discussed, where your ordinary income is taxed over 20%, and even in the 32% bracket, the long-term capital gains rate is only 15%. Now, when you hit those higher tax brackets, your long-term capital gains rate can go up to 20%, which is still much lower than your ordinary tax rates. Now, planning for retirement is always helpful. In fact, it's never too early in the year to start contributing to your retirement plan. Now, here are the current retirement contribution plan limits. Some have increased for 2026. Also, for those aged 60 to 63, there's a new super catch-up provision that allows you to contribute even more to your pensions. So if you're age 60 to 63, this is a great time to check with us as to your eligibility to use this new rule. Now, if you have any questions about your retirement plan, please do reach out to us. Now, you might want to examine taking advantage of annual exclusion gifts. For 2026, the maximum amount of gift tax exemption remains $19,000 per person. For example, you can give up to that amount per person to a family member without having to pay a gift tax or file a gift tax. The way we like to say this is if you can give $19,000 per person per year. As an example, a married couple can gift up to 2 times $19,000 or $38,000 per year per child if they choose. Remember, one $19,000 counts for the one spouse, one $19,000 counts for the other spouse. Now, some ideas for using this annual gifting can include contributing to a working child or a grandchild's IRA, or gifting to a 529 plan, which is a tax-sheltered plan for college expenses. As I'm sure you're already aware, the One Big Beautiful Bill Act was signed into law on July 4th of 2025. It incorporates a wide range of tax and spending policies to provide relief to taxpayers and boost economic growth. Now, this bill was made permanent many of the individual tax cuts and reforms of the Tax Cuts and Jobs Act from 2017 that were set to expire at the end of last year. While there was much packed into this act, here are some of the key items we feel apply to a large group of our investors and savers. Now, the One Big Beautiful Bill contains many changes to tax laws and rules, and some of those changes include the TCJA nearly doubled the standard deductions while eliminating personal exemptions. The OBBBA made higher standard deductions permanent and also provided a slight increase. So starting in 2025, the deduction was increased to $15,750 for single filers, $23,625 for head of households, and $31,500 for married individuals filing jointly. There is a new deduction for taxpayers who are age 65 before the end of the tax year. From 2025 to 2028, qualifying individuals can deduct up to an additional $6,000. Now, the deduction phases out for incomes above $75,000 and $150,000 jointly. This deduction is meant to partially fulfill the president's campaign promise to eliminate taxation of Social Security benefits. However, Social Security benefits are not required to qualify. Starting last year, the state and local deduction, known as the SALT, is raised from $10,000 to $40,000 with a 1% increase in the cap each year through 2029 before returning to the $10,000 limit for 2030. The $40,000 deduction cap is phased down to the prior $10,000 cap for taxpayers with a modified adjusted gross income over $500,000. The phase down occurs over a $100,000 range, and therefore taxpayers with an MAGI of $600,000 or more are limited to a SALT deduction of the $10,000. Now, also starting this year, the bill changed some of the rules for charitable deductions. For today's purposes, we are not reviewing all of the changes from the bill. However, as the year unfolds, we will try to continue to bring you information. Now, allow me to turn this back over to Mr. Lee. Chris?
Thank you, Manny. As we noted earlier, we like to be more proactive than reactive with your tax planning strategies. Here are some proactive tax planning strategies because, as we said earlier, we believe that taking that proactive approach is better than the reactive approach, especially regarding income tax strategies. Ed Slott, one of the premier advisors on taxes, has a rule he likes to call his always rule. Always pay taxes at the lowest rate, even if that means paying taxes before they're required. These are words to live by. The original Secure Act changed the required minimum distribution age from 70 and a half to 72. The Secure Act 2.0 pushed that age even further to age 73. Distributions are required to begin by April 1st of the year after you reach age 73. The legislation also set the RMD age to increase to age 75 in the year 2032. So anyone born in 1960 or after will start their required minimum distributions at age 75. A critical area to review in tax planning for your retirement accounts is what we refer to as overall family tax bracket management. If you have retirement assets that are not in Roth IRAs, when and who takes distributions from these can make a huge financial difference from a tax standpoint. Simply put, if you're in a higher tax bracket than your beneficiaries, then it might make sense to let them take distributions in their tax bracket rather than you in yours. However, if your beneficiaries are in a higher tax bracket, then it might make sense to take distributions in your bracket, convert these accounts to Roth IRAs, and leave them in that account. Still, they must be taken out in 10 years after your death, but they can grow tax-free for up to those 10 years. A key step that we like to start with to help our clients with looking at tax minimization is to compare your marginal tax rate with your beneficiary's marginal tax rate each year. This is something we try to think about for clients, especially those with large retirement accounts. Let's quickly review from a big picture standpoint Roth IRA conversions. For some people, exploring a Roth IRA conversion can be helpful. Some benefits from Roth IRA conversions include they may reduce your overall lifetime taxable income, even though the conversion itself is taxable in the year completed. Roth IRAs grow tax-free and qualified withdrawals are tax-free. Roth IRAs are not subject to a required minimum distribution during the owner's lifetime. Beneficiaries can receive tax-free withdrawals, though they are generally subject to a 10-year distribution rule. Partial or full Roth IRA conversions are not appropriate for everyone. Whether to convert some or all of a traditional IRA depends on your specific tax situation, your cash flow, and your long-term goals. A tax projection is an important step to determine the amount of an appropriate conversion. As with many financial decisions, there are advantages and trade-offs. Please contact us or consult with your tax advisor to determine whether a Roth conversion makes sense for you. The increased standard deductions are a benefit to many taxpayers. How can we take advantage of this? For those of us who are close to the standard deduction level, a strategy to consider is called bunching. Bunching your charitable deductions into a donor-advised fund. Our example, for someone who is slightly over the standard deduction each year, we can bunch 3 years of charitable contributions into a donor-advised fund and take that deduction all in 1 year. This could bring that taxpayer a much larger overall tax savings, and in this example, a 3-year bunch of deductions all in 1 year. Then from their donor-advised fund, they can give to their favorite charity their money each and every year. Now is the time to explore if it's helpful for your tax situation to deposit cash or appreciated securities or other assets into a donor-advised fund, and then distribute the money to charities over time. For more information on this strategy, please reach out to us. Qualified charitable distributions, or QCDs, can be a tax advantage gifting strategy for retirement accounts. For 2026, the maximum qualified charitable distribution is $111,000 per individual. This means that someone 70 and a half or older can donate $111,000 from their IRA to a qualified charity without having to include the amount in their taxable income. One idea that experts suggest if you are charitably inclined is to consider using part or all of your required minimum distribution to fund a qualified charitable distribution. So if you're age 73 or older, I want to point out that you can make this RMD your qualified charitable distribution. I also want to point out that you do not need to be taking an RMD to use this provision of QCD. You can utilize this as early as age 70 and a half. So if you're charitably minded, this is a primary strategy that we like. Like many other strategies we're discussing today, this is one you should see us about and consult with your tax advisor on. To wrap up this session, let me bring back up Mr. Brent Beverly.
Well, thank you so much, Chris. Well, let's look at what comes next. One of our goals is to try and help our clients learn when changes come about. So while many of the tax changes that were passed under the old BBBA were called permanent, and you can't see me running my quotation marks in the air here, but permanent, what that really means is that it takes an act of Congress to change the law again. It doesn't automatically expire, it just takes an act of Congress. So unlike many of the provisions of the 2017 tax bill, which were expected to automatically revert to the previous law this year, the new changes don't do that. They will take an action by Congress and the president to actually change the law. Well, guess what? Laws do get changed, so do stay in touch. And during the course of this year and beyond, be prepared to hear from us on both changes and opportunities as they take place. Again, we believe that taking a proactive approach to your tax situation could yield better results. We'll continue to offer communications to help with that. Please read our special tax report, or if you do not have a copy, we encourage you to request one. It's also on our website. It offers valuable information for filing your 2025 taxes, as well as proactive tax planning tips for 2026. Now, please connect with our office and we can send a copy of this report to you or anyone you feel may benefit from this information. We're very grateful for you, our clients, and appreciate the opportunity to partner with you in your financial journeys. We look forward to serving you in 2026. This year, one of our goals is to help more people just like you. So the best compliment for us is a referral. The number one way we get paid if you read our sheet on that. So some of our best clients were referred to us by existing clients. As you know, someone you think may benefit from our services, please feel free to invite your friends and family. We would appreciate their contact information so we can add them to our distribution list to receive our newsletters and so we can invite them to attend future presentations like this. Again, thank you for working with us. One of our primary goals is to keep you informed, and we appreciate you watching this update. There's some important legal disclosures here. Please pause this so you can take a look at it. We are thankful for the opportunity to assist you in your financial needs. Remember, at our firm, clients always come first. Your health and well-being is always our highest priority. One of the major advantages as a financial advisory firm is the advisory groups team, which we like to refer to as our TAG team. We're proud of our TAG team and the high quality of service we all provide. Now, here's the information for you to reach us. We're glad to be of service. Please reach out to us if you have any questions, comments, or want to meet us. Thank you for tuning in. This concludes our presentation. Have a wonderful day, a great year, happy, healthy, safe, and prosperous.